Hey everyone, as you guys can see, very volatile year, over 20% drawdown on the S&P 500, a pretty V-shape-ish recovery, up 25% off that, and nearly back at all-time highs, now with a pretty large correction, even a technical bear market in for the year. I want to clarify my picks for kind of the rest of the year. A lot of them are the same at the start of the year, but there are some new names on my list. So I thought I might explain. But before I show you a little bit more, I want to start with a quote. And the best stocks make their lows before the general market averages do. During a correction, as the major market indexes make lower lows, the leaders diverge and make higher lows. The stocks that hold up best and rally into high ground off the general market low during the first 4 to 8 weeks of a new bull market are the true market leaders capable of making spectacular gains. Now, this quote is from Think and Trade Like a Champion, and essentially, the premise of it is very simple. Every year, we see market leaders, and the market leaders sometimes are the same year after year, but really, after every correction, new market leaders emerge, and sometimes same as the past market leaders. But often, the easiest way to check is just they're the strongest stocks. Why are they the strongest? Because they're so good that people don't want to sell them in a correction, and when they can buy the dip or when they think the correction's over, they're in right away. So the ones that are like that are very strong. As you can see, small caps are nowhere near all-time highs, where the S&P and the NASDAQ are basically at all-time highs. So I want to go over some stocks that meet that criteria, some that don't, and why I like them. But essentially, what's on my list to start off is Marvell. Now, Marvell is a chip company competing primarily with Broadcom. That's the worst thing, really, is that Broadcom is so spectacular and that's their main competition, and their indirect competition is Nvidia. But at first glance, if you're to look, like, they had a profitable quarter. However, you look at previous quarters, they're actually losing money on a GAAP basis. Now, this is due to some one-off restructuring costs, large amount of amortization on the intangible assets. So I do think it's pretty fair to adjust the earnings here, not including stuff like stock-based compensation, because that is just garbage. But, the amortization of like the intangible assets, that's kind of stuff that I don't consider too much. So after my adjustments, I look at this, and its P is something like 57, which, giving its very stellar top line, bottom line growth, I think this is a good buy. And it's one of the few names in this section that, unlike the rest, hasn't really recovered. Now, this goes opposite to the first quote I showed you. This is kind of a loser. But, sometimes you're a loser and then suddenly you catch up. I do think this is not a fundamental loser. I think the chart looks pretty good. I think it's really a loser because, sentiment, they delayed their investor day, stuff like that. So I think this is a pretty good one to watch. Probably a good long, and I do actually think you'll catch up. But just with their growth prospects, it doesn't really make too much sense for this to be suppressed as it is. And a lot of it, sentiment, is easy to be bad when the market's weak. But with the market getting kind of bullish and almost euphoric again, it's much easier for sentiment on a name like this to recover. And it's kind of like a sympathy trade, which typically I wouldn't recommend, but I do think that it makes sense for this one. The next one I want to mention is a camera for drone company called Next Vision. This one kind of aligns with the quote. It's very, very strong. Comparing it to Tel Aviv, Tel Aviv arguably even stronger. So you could argue this is weak in some ways, but essentially it barely corrected when other things were correcting. It was very, very strong. The chart looks very healthy. And everybody kind of knows drones are a trend that's accelerating. And while most drone companies like Red Cat have anemic revenue and lose money like crazy, Next Vision is quite the opposite. Good revenue and mega profitable. So that's always wonderful. And when people think of the first part of a trade, oh, drones are hot, I want to buy drone stock, people often just forget about the next part of that. Like, these drones need their cameras, right? So maybe you can think about the camera. The next thing I want to mention would be United Health. Now, United Health, once again, it is a loser, it's a laggard. I do think that this is kind of overblown. And, a strong dividend raise doesn't look too bad to me, doesn't look like fraud. You got the CEO and CFO buying in a very significant quantity. So I think this blue chip is actually a good play for the rest of the year, but not too much else to say on that. P6 is one of my few favorite stocks. I made quite a few videos on it. I went through some good times, some significant drawdown, but today I'm happy. It's at all-time high, very strong, better than the market. Comparing it to similar-ish peers like VST and CEG, as you can see, P6 is obviously the clear winner here, and it's something that I want to trade in and out. So this watch list, it is my picks for the rest of the year because I like them, and some of them I think are the best catch-up plays, some of them I think are the strongest, but essentially it's not necessarily that I want to be long for the whole year, but I do still want to be kind of in and out trading. But these are my preferences of ones to be long and ones I favorite. And a really good news for P6 is it's going to enter the Russell 2000, 3000. If you guys followed me for any period of time, you guys know I'm pretty anti-index, and it feels pretty joyful to know that this will be included in those indexes because it improves liquidity, and I can essentially do what Wall Street does, which is pump stocks astronomically and then dump on passive holders who are forced to buy. And anybody who's taken, maybe something like microeconomics knows that when the buyer is inelastic, they can't really have any say on price. And that's kind of the idea that, Wall Street's going to pump this up, and then they're going to dump on a buyer who has no choice but to buy because that's just how these funds work. So this is a pretty good name in that regard. And Marvel, I forgot to mention as well, it should be in the S&P 500, but because of the gap standard and all those assets, intangible assets namely, they are not profitable, not in the S&P 500, but with such a huge surge in profits, even on a gap basis, they've been profitable for a couple quarters. So I think this is a probably pretty early front run into the S&P entry that will probably be in 6 to 9 months. So the next one I want to take a look at is Valera. I really like this one, but oil kind of sucks, so it's not an easy trade by any means. I think this oil company has the best prospects. I was ideally hoping to hold it long for a nice trend, but that didn't happen. So thinking about it and thinking that it's related to commodities and this is really a trader's market, I do think this is one of those names where you're just buying the dips and kind of selling the rips, and it's a very simple philosophy. Hood has been incredibly strong, getting to the market first. Its correction in April was actually extremely modest, in my opinion, just because it has high beta. And I know, it's pretty absurd to say that on over 50% correction, but I do think given its beta is actually extremely modest. Now, I was pretty bearish on this, primarily because I thought they wouldn't recover due to quarter one earnings being worse than quarter four. And I expect quarter two to be worse once again, just primarily due to crypto problems. But, the market obviously likes this one, retail like it, so that is an upside nonetheless. They had some sort of correction because they didn't make it into the S&P 500, but I think this name really is inevitable. So, there's no reason why Wall Street and, retail wouldn't push this up, just because, if you can push it onto a buyer, which will be S&P 500 ETF holders, and they have no choice but to buy, why would you let it go at a low price, right? And, I could be wrong just because the fundamental picture looks pretty bad, but I think, just the idea of dumping on passive holders would make this one pretty strong. So this is definitely one to think about getting long on dips. And I would say the key risk really is crypto just dies out too quickly, and perhaps maybe interest rates decrease too much. But this is something I probably wouldn't want to be long into quarter two, and maybe you can pick it up after if things look okay. So yeah, you can hold it for another couple months or even pick it up before then, but probably not hold into quarter two and see how things are after, maybe pick it up again. Comparing it to something like Interactive, as you can see, the relative strength is clear. And one of the beautiful things about buying at all-time highs, a lot of people like to buy the dip. I do too sometimes, but weirdly enough, I do like to buy at all-time highs. And while that sounds extremely weird, the idea of buying at all-time highs is, the market has trillions of dollars, right? When you buy a steep dip, you're essentially saying you're more sophisticated than trillions of dollars, and they're wrong. When you're buying at an all-time high, you're really just agreeing with the market. So I find that while it may be less rewarding and you may buy at a horrible price, for the most part, it's actually typically easier to be in profit right when you're buying at all-time high. Sezzle's a really strong buy now, pay later name. Once again, all-time highs before the indexes. Companies like Affirm, no all-time high yet. Sezzle had quite a drop today because they are trying to sue Shopify. Now, that's kind of weird, and I don't think they really should have reacted this way, but it is what it is. It does, in my opinion, feel a little bit overblown, so, perhaps you can catch it on dips, but it's hard to really chase it here, although, it's so fundamentally good to keep pushing farther. Supposedly, they're taking significantly more risk as their customers, a lot of them are post-bankruptcy. And, with that being said, if the economy weakens too much, this company could have serious problems. But at the same time, companies like Affirm are not profitable. Well, this one has been profitable for a couple of years. So you might, in some ways, you could say their customers are a lot less risky. I don't know, it just depends how you look at it, but this is a really strong one and something to keep in mind for the rest of the year. App, I probably like it the least. I don't think the valuation's too good, nor is the stock that strong. The reason I do mention it and bring it up is because while I say this, it's a high quality company with a long runway. So in some ways, it does deserve a more premium valuation. They also were stiffed from getting in the S&P 500, and for App, it was the second time. With a company of this size and this quality, it does really seem inevitable. And I think the CEO is one of those sandbaggers who always beats earnings. So, the market really likes that. So I think, this one probably not super, super strong, but you can probably keep buying dips and selling rips on this one, and you'll probably be fairly successful. Snap is one of my favorite names. And this one is pretty interesting. So in terms of fundamentals, essentially, if you look at their next quarter, you're looking at a quarter-over-quarter revenue decline and a year-over-year earnings decline. They haven't gave guidance, they suspended it, which is kind of weird because everyone else gave it. But essentially, I don't think this is possible because they almost always have been beating the earnings just on the net income basis. And I do think they're a bit more cost disciplined, so I really can't see them slipping backwards, especially with so much growth in Snapchat Plus. So I think this is just extremely low expectations and probably easy for a positive surprise. Main issue with this is I think it's not extremely time efficient to be long this. So I think the best way to play this is really a poor man's covered call or just a short put. And, at these valuations and with the type of company it is, I don't think you bear too much risk. And the last company I really want to talk about, which I've talked about quite a few times, Hydrate. Now, this one is very interesting, and I've listened to them speak a number of times. And if I'm going to be completely honest, every time I feel more disappointed than the last. And with so many warrants at 2, it's almost hard to break through. I'm not going to necessarily jump out and say I'm wrong on this idea because I do think this has a lot of potential. But before, when I looked at this, I thought, this could potentially be a 10-bagger. Now when I look at it, I kind of think, well, maybe just a 5-bagger if things go well. And, that's not bad. Everybody would love a 5-bagger, but the more I look at it, the more holes I'm seeing. So, just on a rational, risk management perspective, it's really hard to take this more long in size. And I think, it has a good runway of events for the rest of the week, which it could pump off of. But in a longer term basis, I do kind of feel unconfident with this company. And, a lot of that ties into management. And, two of the same companies with the same business essentially can be led significantly different ways by management. And I think there's a lot of problems like the CEO and management team not having enough holdings that really just don't push the incentives in a good way. So what I say about this, I guess overall, am I bullish? Yes, no doubt about that. But am I as bullish as before? Do I feel as confident? No, not really. And I can't help but dislike one of their, payment structures, which they have a royalty to their parent company. And I find whenever I dislike something in the market, or just in life, I guess, I really want to find out what is benefiting off of my dislike. And in this case, it's clear, right? They're paying a royalty to their parent company. So maybe I should take a look at their parent company. And looking at it, it looks horrible in terms of track record, in terms of many different things, their balance sheet, 2 auditing delays, everything looks pretty bad. But the key story is for this company would be Hydrate. And if Hydrate goes up, and I really believe in Hydrate, theoretically speaking, Victory Square should be that plus better because they own the shares. So it's like being a shareholder and receiving a royalty. Now, you also have a bunch of other free stuff, but I guess, you have other stuff to disappoint on. So it kind of balances out. And it's a holding company trading at a discount, but at the same time, holding companies don't really deserve to trade at their net asset value. But because they have a royalty from Hydrate, if Hydrate is successful, they have, a bunch of assets trading below net asset value, and they might be able to produce a genuine cash flow on top of that. And with that being said, if that's done, it wouldn't really make sense for them to trade at this steep of a discount. So I think that the parent company probably poses less risk if they are able to successfully release their quarter 4 because, they've had some auditing problems. But yeah, essentially you're looking at potentially less risk and potentially more gain. So before, I didn't think it was a good idea to long Victory Square instead of Hydrate, but now I feel like it might be a better idea. So I'm still on the fence about that, but yeah. That's kind of where I stand for the rest of the year. at the end of the day, I do think being a trader is good, especially, with Trump being in, there should be plenty of volatile opportunities. So I have my picks, and it's all about just trading in and out of them. So I hope this is somewhat useful. But if you want to ask anything, feel free to leave a comment. And yeah, that's all.